Hey everyone, Ryan Reynolds here with Keller Williams Consultants Realty. Thanks for joining us, RG family. And today with me is David Arocho with NFM Lending. David is a longtime partner of ours. He's with NFM, again, one of the fastest growing companies, mortgage companies here in Central Ohio. So how are you today, David?
I'm doing great, man. Thanks for having me, Ryan. Appreciate definitely the opportunity. So thank you.
Well, thanks for being here. I know we had a little bit of a time getting this set up, so my schedule, it's been a ride.
I'm really not that difficult to get a hold of. I'm really not, I promise.
Oh, I know you're not that hard. It's just it's actually, you're really easy to get a hold of, which is actually one of the great things about you. So one of the things, we haven't talked about this at all, but one of the great things I think about you is that when we have clients that need to get pre-approved on a weekend, we can get that done with you, right?
That is correct. And listen, I take a lot of credit, but I also give my staff a lot of credit as well too. And we make ourselves available, so obviously myself and my team make sure that I have team members available on rotating weekends for that reason, because we understand you and your buyers' needs. And even though we hope that buyers are pre-approved in advance, we know sometimes, they see that property at the last minute and they've got to get things done on the whim. So definitely so. And we appreciate the fact that we're given that opportunity, and we like the fact that we can do it for you guys on the weekend.
Yeah, no, we really appreciate it. And I know our clients appreciate it too, but it actually brings me to the market. So let's talk a little bit about that. So from the real estate side, obviously this time of year, things starts to slow down a little bit. We typically see a lull from somewhere in the August timeframe, and then it starts to pick up around the third, fourth week of September. And I know just for our team, we have a lot of things coming here in October. What are you seeing on the mortgage side of business? Is that pretty typical with the rest of the market?
It is. What I found interesting this year, especially over the Labor Day weekend, was, which again, over the last 3 or 4 years, no matter what the holiday weekend was, you were still busy as like if it was any other day. What I found over the Labor Day weekend this year was it kind of went back a little bit to normalcy. We found like things were back to where, it wasn't as crazy. It wasn't, you had your weekend off per se, so that was kind of nice. I'm not for sure if that's the trend. It's kind of been volatile of late. We've noticed that, again, like yourself, our October, very, very strong for October on both the purchase side and a handful of the refis. And those have obviously have been trickling away over the last several months. So the purchase market, which has always been our dominant thing anyways, remains strong. And right now, from what we're seeing, October's looking good. It's hard to say, Ryan, where the rest of this year might look. A lot of analysts have predicted rates to be at 3.5%. A lot of them have believed, maybe we'll see a slowdown as of next year because of the shrinking of the purchase market next year. But right now, I think for here, Central Ohio, things remain pretty strong. And I will add one more thing. The buyers that we kind of pushed out in the market over the last 2 years because they didn't have the means to pay 20 or 30,000 over list price and compete in this market, those buyers are beginning to see somewhat coming back now because they're noticing that there is a somewhat of a softening of the market. Maybe it's not as crazy or as how much it's been going for the last several years. So we're beginning to see some people coming back in the market, testing the waters to realize that, hey, they're getting to see some properties that now might be sitting over after the first week, and that could be of interest to them. Yeah,
I definitely would say we see that same thing on our side, is that the properties we were getting 25, 30 offers on in the springtime, we're getting maybe 5 or 6 or 7 offers. So still competing,
absolutely
not competing against quite so many people.
Right.
I'm sorry,
go ahead.
I'm just go ahead and finish the thought there.
No, I was going to say, over, like I said, the last several years where we have found a lot of the government buyers, our veterans and our FHA buyers who unfortunately, maybe have been somewhat pushed to the side to some degree on this conventional market we've had over the last several years. Those are the ones, again, I've always said, those buyers are going to be just as vital as any other buyer, because when this market does soften and sellers are not getting multiple offers, they're getting 1 or 2, then those veterans and those FHA buyers now become very instrumental. So those are the ones we're beginning to see also coming out as well.
Yeah, for sure. I think that's going to be a bigger component, and that'll start to come into play a lot of times, even in the wintertime. If you're a government buyer like an FHA, VA, that kind of thing, it's a little easier to get approved, or not approved, but get your offer accepted in the wintertime. So really a big opportunity for those folks kind of coming up.
Absolutely.
Let's switch gears just a little bit and go talk about the refinance. You mentioned that. So I know pretty much everybody in the world has got to have refinanced by this point. If they have not,
there's still those stragglers out there for whatever reason. Are still coming in.
Hold on to that 7% rate. Got 10 more years left. But so if just in broad terms, like if your rate is above, what should you consider maybe thinking about refinancing?
The rule of thumb in the past years ago used to be, they used to say 2%. I think 1% starts to look at a significant savings. So I think if a buyer's at about a 1%, difference in interest rate, that's something to consider. The larger the loan amount, the more significant savings they will see. Really, some of your jumbo loans or some of your higher loans, if even a 0.5% could make a difference on the long-term basis. But what we have found over the last year, Ryan, most of the clients that we have refinanced have taken shorter terms. They've taken that 30-year and said, hey, even though I'm not saving on payment, I now have taken off another 5 or 10 years from my mortgage, and many of them have taken a shorter term loan as a result. So that's been a good thing for them.
Yeah, absolutely. Knocking years off is probably maybe more valuable than lowering the payment.
Absolutely.
A couple extra $100, no big deal, but you can knock off 10 or 15 years. That's significant.
What's a savings account? I tell clients, listen, if you do a short-term loan, if you're doing a 15 or 20 year, and let's say you do decide to sell it in 5 years, well, guess what? You have that much more equity in your home because you paid so much more towards the principal as a result.
So just as a kind of a rule of thumb, if my rate is above 4% or 5%, when should I call you? Like where I'm at right now, when does it make sense?
I would say, right, yeah, anything at 4% or above, really, that should be something to consider. Now, these are obviously, that's going to be, they will differ when it comes to whether it's owner occupied or it's a rental.
Sure.
So obviously, if it's a rental property, those rates will vary, and those can be in a broad range. But owner occupancy per se at this point, I think if you're at 4% or above, no doubt you want to take a look at it. We've even are looking at some right now in the upper threes who are considering refinancing, again, looking at that shorter term number.
Yeah. And actually talking about shorter term. So like if I drop my loan from a 20 to a 15 or to a 10, does that affect the rate that I'm going to get?
Yes, usually a shorter term loan would provide you a lower rate of interest. So generally your 10 and 15 years are going to be a better rate of interest than that of a 20-year versus a 25 or 30-year term. But yes, you are correct.
Okay, so that can kind of help offset some of the difference in payment because you might be paying a little bit more.
And what we'd like to do too is when a client's looking at doing a shorter term loan, one thing I like to provide them is show them, okay, if you keep your existing mortgage, we show them what that will equate to and how many total of payments. And then we show them what the number of payments will be if they did a shorter term loan. And when they start to see that big difference in interest is when they start to look into it. When they start saying that makes a big difference or why we should do that. Now, on the flip side, I always tell clients this too. Don't strap yourself either. Don't take a shorter term loan because the number looks good. Think about the long term of impact. If one of you lose your jobs, is that payment still comfortable? So you want to look at other reasons as to why you should take that loan or not take it.
Yeah, that makes a lot of sense. I think I know just in my personal business, a lot of times with our rental properties, I've financed and refinanced a lot of them with you guys this year. And I want to say that many of the times I'm taking a 30-year rate, even though I'm making a 15-year payment. And
absolutely
intending to save that over the long term,
which is the luxury. The luxury is, yeah, the nice thing is if you do a 30-year amortization, you have the ability to pay that. You can make your own term on that loan to pay it down in 15, 20 or 5 years. The moment you have subject yourself to a 10 or 15 year, now you have to make that higher payment every month. That 30-year gives you that luxury flexibility if there's that month you can't do that.
Right, makes sense. So let's talk a little bit about future. And I know you've got a crystal ball. I can see a couple around.
Just call me Cleo.
Yeah. So what do you see in the next 6 months to a year? Where do you think rates are going?
Well, listen, again, I think they were projecting rates to be in the mid threes before the year was out at the beginning of this year. And these rates relatively, listen, for the most part, they have ranged in the upper twos to the very low threes has been that consistent range for typically buyers who have a certain credit score threshold and so forth. So there are going to be certain requirements. Some programs might be at 3.25 to 3.5 based off of certain guidelines. But still, rates remain relatively strong. Again, we've seen a shifting up over the last several months, so they have inched up a little bit. But historically, Ryan, they still remain great opportunity for buyers to still look to buy because again, these rates, I expect. I think with the housing market the way it is and such the impact that it has on our economy, I don't see these rates really shifting very much. If they do, they're very slightly, but right now we're not seeing much of a shifting either way. If it is maybe 0.25% at times variance, but for the most part, I think they're going to stay really, for at least at the end of this year, I expect they'll remain as strong as they have been of late.
Yeah, I mean, one of the things that's in the news has been the inflation rate. When you think about 3 or 4% inflation and the rates of the loans are somewhere in that same range or maybe less, it's actually cheaper to borrow the money than it is to pay cash in some cases. And maybe some
You're right,
promoting after
exactly.
that, that thought, but anyway, so. Okay, so do you think rates are probably going to be fairly steady over the
I
next
think
6
so,
months?
yeah. But listen,
Yeah.
it's a vicious, I've been in this business long enough to see that it goes up and down. Listen, if the rates hit 4% or 4.5%, guess what? People still buy. So the housing market doesn't stop because the rate hits at that point. And again, when the rates do hit at that level, we let the buyers know, we show them what the history has been and say, listen, you might be sacrificing a rate because it has gone up because of the market. But hopefully at that point too, if the rates are higher, your portfolio is doing better as well too.
Yeah.
So it's a win-win overall. But again, a 4.5% rate 6 months from now, if it were to be that, the likelihood of that being back to 3.5 in the next couple of years thereafter are very probable. So those are the refinance buyers at a later date. But for buying
Right.
purposes, the rate never seems to. I think that the rate doesn't really typically stop the buying process per se.
Yeah.
And I don't
People
think they're going to get out of
don't-
whack. I can't see them going. I think that's our housing market has such a stronghold right now, is a positive thing in our economy, that shifting those rates too much and moving buyers away from the housing market, I don't think would be a good thing right now.
Yeah. Well, honestly, even if the rates go up, I mean, my first mortgage was a long time ago, but I was at 7.25%, and I was really happy to be getting that 7.25%.
Yeah, it was a
I
great
went to
rate back
5.
then.
Like, holy crap! I can't believe this. And then it went to 4, and then it's gone down from there.
Listen, I'm going to age myself when I say this real quick, but I got in this business years ago in the servicing side of it. And I was doing what they called like collections or foreclosures, unfortunately, at the time. And I was seeing people at that time with a 15-16% interest rate. So when the rates went down to 13%, everyone thought they hit the lottery at the time when it was time to refinance. So you're so right that, we, the generations today don't understand what many of us have seen back then. And the rates today, if they hit 3.25%, is phenomenal historically. So that's why we tell buyers, don't that rate should be your factor. Don't let your rate should not be the reason why you should buy a house or why you should not buy a house. But just understand that that's going to afford you a comfortable payment as they remain at these levels.
Yeah, actually, speaking of foreclosures, let's just chat real quickly about that. So, I don't know, you probably pay attention to the default rates and things like that, I would imagine. I get questions all the time. Are we in a housing bubble and it's going to burst sometime? We're going to go into all these foreclosures. So, just in terms of default rates, do you have any background on where people are right now?
I can't really say at this point. Obviously, there's been so much over the last 2 years with all this holding off of potential foreclosures in the housing market and so forth. So there really is some unknowns. Do I think that if there's going to be a foreclosure wave of any sort, is it going to be like the wave of 07, 08? Probably not.
Yeah.
I think the mortgages today are far better package deals today than they were back at that time. So if there are going to be any, I don't know if will it be an impact that's going to impact our housing market like it did in 07, 08? Probably not. Not at the moment.
I would agree with you.
I'm not hearing of these significant default rates that are going to push foreclosure rates. Not right now.
Yeah, and even if people, I think honestly, most people won't be foreclosed upon because most of them have equity, and based on the notes that have been written since 2008, really, they were pretty hard to get. People had to put money down, and equity has built since then just naturally to the market. So unless they're refinancing and taking money out all the time, then I can't imagine that there are very many people underwater.
The sellers today probably are in a far better position than they were on those of back in 07, 08 when the housing market and the properties declined. We had a decline in value. Right now, it's the opposite. So a lot of, like you said, a lot of these people probably have equity and have every reason, hey, sell your house before you would ever lose it because you've got the equity to do that. So a little bit different situation, I would think, for those who unfortunately may be encountering that struggles right now. If that's the case, hopefully, like you said, the equity makes them a win.
It covers it. They can probably sell. Yeah,
absolutely.
Okay, well, great. Well, I think I'll just wrap it up here then. And what last thing I want to do is really say thank you so much for sponsoring our client events, for taking great care of our clients, and for taking good care of me and my family. So I appreciate that, David. 100%. Actually, a lot of my family, when I think about it, not just me. If someone wants to get in touch with you, what's the best way for them to reach you?
At this point, they can reach out to me here at a couple numbers, 614-840-5013, which is my office line, or 614-657-1167 is my cell number. I also have a team. So again, a lot of times if you call me and I can't get to you, one of my team members will likely reach out to you if I'm unavailable. But yeah, we really appreciate the opportunity, Ryan. Again, at the end of the day, we're here to earn the client's business. It's not a matter of just give it to us. We're here to earn it. And we appreciate what we hear from your clients. And again, you're the quarterback, we're the running back. Give us the ball, meet you in the end zone. You're on to the next play, you're on to your next client. And that's what we like about these relationships, that you guys do your job and you let us do our job. And that's what makes it a win-win for both of us. So thank you.
Yeah, and honestly, our slogan or tagline is unlimited opportunities, exceptional experiences. And you fit right into that with your team, because I truly believe you provide one of the best experiences for our clients that of any lender. So
well,
thank
I
you for that.
appreciate that. That's hey, listen, I've been on both sides of it. So obviously I understand how a seller could feel or a buyer could feel, and I would want that same most respect. And listen, I've lived this model for 24 years in this business, and it has worked very, very well for me, and I won't change it. We lose, I think too many companies have lost the customer service level. It's gone to the wayside, and I think in our business, it's a personal thing. We like these relationships, and these are our long-term clients, for long-term. So thank
Absolutely.
you.
Well, thanks again for taking the time to talk with me today. I really appreciate it. And I'm sure we'll be talking to you in the future. Our RT family, thanks for tuning in, and we will see you on the other side. Have a great day.
You too, man. Thanks.